What happens if the car you are using mainly for business purposes is not titled to your corporation or LLC and it belongs to you personally? First, since the car is not under the business name, the car is not a business asset. It is a personal asset. So you should pay all the expenses from your personal accounts. Second, how can you deduct the car expenses, since even though this is a personal asset, you are using it for business purposes? Well, how you deduct these car expenses depends on how your business is set up for tax purposes and also on what business agreements are in place. But if you are an employee of your own business, you can use an arrangement called an Employer Reimbursement Accountable Plan. This plan will allow you to submit a mileage reimbursement request to your own corporation or LLC. Having such a plan when making mileage reimbursements to yourself is very important, because otherwise the IRS can treat the mileage reimbursements as wage income to you, meaning that you will have to pay unnecessary payroll taxes or you can get into other complications. Now, an Employer Reimbursement Accountable Plan is an arrangement that needs to respect 3 rules. First, you must have paid or incurred deductible expenses while performing services as an employee of your company. Second, you must return any excess reimbursement within a reasonable period of time. And third, you must adequately account to your company for these expenses within a reasonable period of time. This is where the mileage log comes into play. We have a separate video regarding the mileage log requirements, and I will include the link in the description of this video. In addition to the mileage log, you should also keep documentation regarding the cost of the car, any improvements you've made to it, and the date you started using it for business. Now let's see what the IRS means to be a reasonable period of time. Well, per the IRS, a reasonable period of time depends on the facts and circumstances of your situation. But since this is a very murky definition, the government came up with some time frames that they will treat as taking place within a reasonable period of time. Let's see what these are. You receive an advance within 30 days of the time you have an expense. You adequately account for your expenses within 60 days after they were paid or incurred. You return any excess reimbursement within 120 days after the expense was paid or incurred. You are given a periodic statement, at least quarterly, that asks you to either return or adequately account for outstanding advances, and you comply within 120 days of the statement. If you do not fall under these timelines, doesn't mean that you don't have an accountable plan. It just means that the IRS will evaluate your plan based on your facts and circumstances. But of course, the safest way is to fall within these timelines. For more information on the Employer Reimbursement Accountable Plan, I will include a link to publication 463. One more thing I want to mention before wrapping up this video. This situation, where you are using your personal vehicle for business, might not be an ideal situation. Whenever possible, you should have the vehicle purchased under the business name. If you found this information useful, make sure to subscribe, give a like to this video, and leave a comment about any other subjects you'd like us to touch. Thank you for watching.